So we do have a panel this afternoon which will deal with currency politics, European style. Europeans, just after the demise of Bretton Woods, thought that it would be a very good idea to create a zone of monetary stability. In other words, they were not that very much in favor of stabilizing or flexible exchange rates. In fact, the rallying cry for the currency union, which was established in the late 1990s, was one market, one money. So the standard tool which many economists would propose to deal with a current account imbalance, nominal exchange rate, is by definition not available in the European context because monetary policy has been Europeanized, and by definition there's no nominal exchange rate anymore available for dealing with current account imbalances. So how do Europeans go about it? What are potential substitutes for this? This is what we will discuss during this afternoon's panel, and we have a very distinguished group of panelists, of economists. I'll start alphabetically. Alberto Alesina, professor of political economy, and he actually does political economy, in particular business cycle economics, but many other issues, including cultural economics. But he has also been very influential early on in the debate about European integration for the last quarter of a century. We have Dick Cooper, who's been always interested in applied economics, very much so. He's been serving in government. He's been Undersecretary of State for International Affairs. He's been chairman of the Federal Reserve of Boston. And I got to know him as a young student when he wrote very influential articles on international coordination, also with an application on European issues. Jeff Frankel is a professor for the economics of growth and capital formation, which means he looks at anything from international finance to international environmental issues, and he has also been serving in government in the Council of Economic Advisors, in fact, twice, and he is also directing the NBR's program on international finance and macroeconomics, as well as on deciding when the cycle starts and ends. And finally, Jeffry Frieden, who is a prolific writer, and that's somehow the reason why we're here, because we've stolen the title of this panel from his latest book. The book before was on the last decade. This one is on currency politics. And without further ado, I hand over to you, Jeff.
Great. Well, thank you very much. It's a great pleasure to be here. We are talking yet again about the crisis in the Eurozone. As we all know, this has been, I think, without a doubt, the most serious crisis in the history of European integration, and one that in many ways calls into question the entire process of European integration, not just monetary integration, but integration more generally, and raises doubts about the future of the European Union. Typically in this room, we talk about the euro and the crisis and what can be done, and focus on, I think rightly so, focus on the many flaws and problems from the inception of monetary integration through to the failures of the member states to effectively bargain their way out of the current crisis. But I want to do something a little bit different today. And in a sense, I want to ask why the euro exists and why there seems to be such insistence on the part of not just political leaders, but also many popular groups and populations within the Eurozone, persisting with the European monetary integration project, persisting with the euro, crisis after crisis. As an example of this persistence, and as in some sense a puzzle, or one of the puzzles that I want to try to address, it should be noted that the Eurozone has 7 new members since its inception, including Greece as one of the original members, which we probably shouldn't. But anyway, 7 new members since then, and 6 of those new members joined the Eurozone after the crisis had started. right? So given that the Eurozone is hardly a zone of monetary stability in any sense of the word, or stability of any kind, why is it that it seems to be politically, from the standpoint not only of politicians and political leaders, but mass publics, why does it seem to be still relatively popular to join and stay in the Eurozone? I can point, by the way, to a recent interesting Brookings paper by Guizzo et al., in which they demonstrate, using public opinion surveys, that the Eurozone, among all the current member states, remains very popular. That is, the vast majority of respondents still are in favor of the euro. The ECB is not so popular, in fact, very unpopular, but the euro itself is very popular. So most of the explanations out there that we've used, including me, on the euro and on currency unions more generally start with the well-known optimal currency area considerations, and in that context focus on how giving up national control of the currency could impose costs on a country, or to put it the other way around, it makes sense to join a currency union when the costs of giving up your own currency are relatively low. And then they identify characteristics of the national economy, diversification, correlated exogenous shocks, factor mobility, that reduce the costs of giving up a national currency. In other words, that make it less attractive to have your own national currency, either less feasible to have your own national currency, or less attractive to have your own national currency. And as many of you will know, a lot of the economic and other literature demonstrates that the Eurozone really didn't satisfy all of the characteristics of an optimal currency area at the time that it was adopted, and may still not satisfy those requirements. But I want to look at something different, in some sense the other side of the coin, so to speak, and that is the potential benefits of sharing a currency. As the optimal currency area typically focuses on the potential costs of giving up a currency and simply assumes that there is some benefit to having a common currency. Now, this has always been a problem in the purely economic literature, because in theoretical terms, typically it's assumed that the benefits of having a common currency are very limited. After all, for the countries in question, there are deep forward markets for currencies, right? And so you can always hedge, and so simply sharing a currency may not have substantial benefits, right? But often this general argument hasn't received a lot of attention. In the last 15 or 20 years, however, there's been some more particularly empirical attention to the potential benefits of sharing a currency. Andy Rose has an influential article that a lot of people don't believe, which found, or purported to find, that countries in a currency union, countries sharing a currency, traded with one another 300% more than they would have even if they had pegged exchange rates. That is not true. 200% more. 3 times as much. 200% more. 3 times as much as they would have otherwise. That may well be an overestimate, but there are other studies, for example, an influential one on the gold standard, which find that having either a common currency or some reasonable facsimile thereof has a substantial positive impact on integration in trade, also in finance and investment. So the first point that I want to make is that there are, I believe, and I think there are people in Europe who believe strongly that there are powerful economic effects of a common currency associated in a sense with encouraging or speeding the process of European economic integration, the integration of goods markets, capital markets, and even perhaps the market for labor. There's another piece of empirical evidence that's been gathering over time, which has to do with price convergence. And since we're on a limited time frame, I can come back to this, but Roberto Rigobon and his colleagues at MIT have this remarkable Billion Prices project, which uses scanner data to compare prices across borders. And without giving details, what they find is that prices do not really converge very much among countries that have floating exchange rates, that they don't even converge very much among countries with fixed exchange rates, but they do converge by an order of magnitude greater degree among countries that share a currency. The most striking example of this is that there is a profound difference between the convergence of prices between Spain and Finland in the euro and between Spain and Denmark. Denmark is as close to being in the euro as any country could be, and yet the price dispersion between euro members and Denmark is similar to the price dispersion between euro members and Sweden, which is not in the Eurozone. So this, again, is evidence that being in a currency union can have profound economic effects that speed or encourage or the process of economic integration. So if you are a person in Europe or an interest group or a government that wants to speed or encourage the process of economic integration, the currency union may well be a powerful tool to push things in that direction. That's on the economic front. But there's a political economy front as well. That is a positive political economy argument for currency unification, especially in a single market. And that is that we know that there is a very strong connection between currency movements on the one hand and trade policy. After all, a 10% devaluation is the functional equivalent of a 10% tariff and a 10% export subsidy. So that if you are denied the use of trade policy, a government could rely on currency policy to achieve much the same effect. Well, we know that that's true even in general. We see that to a certain extent in today's world, macroeconomic debates are in many ways more conflictual than trade debates. The US-China trade relationship is mostly embedded in debates over the Chinese currency. That relationship is heightened within countries or among countries that have pursued much more systematic trade liberalization, such as in a customs union or a single market, such as in Europe. I'll give one analogy and then give the European case. In the early 1990s, early to mid-1990s, Argentina and Brazil and a couple of other countries created the Southern Common Market, Mercosur. At that time, Brazil and Argentina had pegged their currencies to the dollar, 1-to-1. So the real, the peso, and the dollar were 1-to-1-to-1. When Mercosur was created, there was an almost immediate, very rapid uptick in intra-Mercosur trade, very dramatic. And that went on for about 5 years. In 1999, the Brazilians devalued the currency very substantially. There was a flood of Brazilian imports into Argentina. There was a dramatic outcry of protectionist pressure in Argentina. The Argentines threatened to impose protectionist barriers and, in fact, to pull out of Mercosur. The Brazilians voluntarily, quote unquote, limited their exports to Argentina. After that, in 2001, 2002, there was a dramatic devaluation of the Argentine peso and the process was reversed. The bottom line, the conclusion of all this was that the currency movements within Mercosur completely stopped and to a large extent reversed the trade integration that had taken place between 1994 and 1999. And for all intents and purposes, trade integration in Mercosur is a dead letter. I would argue, at least in large part because of the rapid and large-scale currency movements at the time. So that's an instance in which these rapid currency movements essentially undermined the attempt at trade integration. The Europeans went through a similar experience to some extent in the early 1990s. In the aftermath of the creation of the European monetary system and its stabilization in the mid-1990s, and again in the aftermath of German unification, there was the currency crisis, the crisis of 1992-1993, which led to very substantial devaluations among some members of the then European monetary system. One of the effects of that was a flood of imports from the countries that had devalued into Northern European countries, which led to protectionist pressures. And at one point, the French government actually threatened to impose emergency tariffs on goods coming in from Portugal, Spain, and Italy. That, I think, demonstrated to many that it might well be the case that the single market was inconsistent with unconnected, unlinked national currencies. That as long as national governments had the ability to depreciate their currencies for competitive effect, that the single market as a unified trade entity could not be stable. Right? So that's a political economy or political argument as to why currency unification is, on the part of many, seen as an essential component part of the process of European integration. So all this is to say that in my view there are real reasons, and I use real in both meanings of the word, real as opposed to monetary and real as opposed to fictitious, real reasons why sensible, rational politicians can regard economic and monetary union as crucial to European integration. First, because monetary unification speeds the process of economic integration more generally. Second, because a single market may be inconsistent with separate national currencies that bounce around. Of course, there are many possible paths to achieving this goal, and it's clear to everyone, I think, that the Europeans have not chosen the best possible path. But I want to be sure to point to the fact that there have been and remain positive incentives to try to achieve, maintain, sustain a unified currency.
Thank you very much, Jeff. Now, one reason why Europe is in dire straits, in need of adjustment, is of course budgetary crisis, which we have in numerous EMU member states, and Alberto Alesina will talk to that.
Okay, thank you. So my goal is to talk about the European fiscal crisis, but so I think in the first round we put up a lot of issues, and then we'll have a general discussion. But I cannot stop from commenting on what Jeff said, because I was sort of shocked in hearing that economists had no idea about the possible benefit of the monetary union. They always thought about cost. And I think that, I'm not sure exactly where he got that, because there are tons of papers discussing the pros and cons of monetary union. For example, I remember discussing one paper by Maurits at the onset of the euro, saying, which was an 80-page paper about the pros and cons of now, maybe the pros are superior to the cons or vice versa, but I wouldn't characterize the discussion amongst economists and saying there are only costs, and therefore why would we do a monetary union? Anyway, I'm sure we'll discuss that later. I'm supposed to talk about European fiscal crisis. And in fact, in the instruction I got from Harpel was to say you should go there and discuss the benefit and why Europe could not do anything else other than austerity. And I'm not exactly sure that what my view is. I think my view is that because of a series of mistakes made in the first 10 years of the euro, Europe found himself in a way in which probably the only, or at least some countries in Europe find themselves in a situation in which the only way out was to engage in deep austerity program, probably too soon after during the Great Recession. So maybe austerity was the only, third best outcome in a dire straight situation. So I'm going to talk about three things. The timing of adjustment, was it too soon after the crisis? Second, what type of fiscal adjustment have been more or less successful in terms of limiting the output losses? And third, have the current round of fiscal adjustment been particularly more painful than before? And if so, why? On the first question, as economists know well, I think it's the bad idea to engage in restrictive fiscal policy during recession. You want to allow automatic stabilizer work, and therefore you want to have deficit during recession. And you don't want to do restrictive fiscal policy during recession, and vice versa. You don't want to have expansionary policy during booms. To some degree, Europe did quite a bit of the opposite. This graph shows essentially on the output gap. When the output gap is negative, it means that you are in a recession, and these years see when fiscal policy has been tight or loose on the vertical axis. So 2010, 11, 12, and 13 were years of severe fiscal restriction in several countries in Europe, in moments in which the unemployment was high and the output gap was negative. On the other hand, in some years previous to the crisis, there was expansionary fiscal policy in many countries, even though the economies were doing reasonably well. One case would be Italy, which didn't quite adjust its budget problem for a couple of decades. Greece, not to mention Greece, and a bunch of countries borrowed a lot during the 10 years that led to before the crisis, and in ways which, in principle, there is nothing wrong if in a monetary union a country borrows from other countries within the monetary union. But the problem is that if you use those borrowing for productive investment, that's fine. If you use them for public consumption or increasing wages above the productivity growth like happened in Portugal or in Greece, or if you invest in a real estate boom that then collapses like in Spain, you're not doing exactly what the economic process of integration would imply. So in 2007, we are in a situation in which several countries, to understand 2008, 2009, several countries are deeply indebted, and there is uncertainty about the Greece contagion, and there is an explosion of interest rate on borrowing countries. These are the spreads on government debt for a bunch of countries. On the left graph, Spain, Italy, and France. On the other side, Ireland, Portugal, and Greece. There's no particular reason why these countries are grouped that way, just they don't fit in one picture. So the point is that up until 2008, 2009, Greece, Spain, Portugal, Italy were borrowing essentially at the same rate as Germany. And all of a sudden, in 2008, 2009, this spread exploded. And the idea is that up until 2008, 2009, either investor did not understand the difference between the fiscal position of Greece and Germany, or most likely, they thought that Greece would have been bailed out, or Portugal and Spain would have been bailed out in case of a crisis. So now we are in 2008, 2009. This mess is occurring for a reason that I won't get into, but I'm sure Jeff and Dick will talk about it. The ECB politically could not react as the Fed did by buying bonds all over the place and throwing money at the system. So there was a risk of debt restructuring, of collapse of debt in several countries, Portugal, Spain, Italy, Greece there was, and so on. And so could Europe have waited to engage in austerity? It's hard to tell. Probably not. The downside risk was debt crisis, debt restructuring, banking failures, because banks were heavily invested in debt, and perhaps an even second round of financial crisis. So perhaps the only choice was the one that was followed of engaging in some sort of fiscal restructuring. So the second question is, which kind of adjustment worked better in terms of fiscal adjustment? There is now, I think, a fairly, I would say at this point, I would dare say, fairly established body of research done in many different ways, showing that at least up to the crisis, with the evidence up until 2007, 2008, European countries and more generally industrial countries that have engaged in large episodes of fiscal adjustment, namely reduction of deficit, have been much more successful when they did so by cutting government spending rather than by raising taxes. Cuts in government spending have been associated with fairly small recession, in some cases with no recessions at all, while increasing taxes have been associated with deep and long-lasting recession. Let's not forget that we are talking about countries where the tax burden are already very high, according to some studies, pretty close to the top of the Laffer curve, so increasing taxes can have very negative effect, not only on demand, but also on supply. And also, if you don't stop the growth of certain program, it's very hard to keep increasing taxes to eliminate deficit, and the adjustment on the spending side are more credible than on the tax side. Now, the question is, do these results on previous fiscal adjustment apply as well to what happened in Europe after 2010? And the answer, based on some recent work with my colleague Carlo Favero, Francesco Giavazzi, Omar Barbiero, and Matteo Paradisi, two of my students, shows that the answer is yes. Even in this more recent round of fiscal adjustment, the same is true. Countries that have acted on the spending side have been more successful than countries that acted on the tax side. I think the one striking comparison is between Italy and Ireland. Italy is a country that did not have a large deficit. In fact, they have a fairly low deficit. And the reason why Italy had a low deficit is because they had such a huge debt that they couldn't afford to run a deficit during the recession. But despite the low deficit in Italy, Italy faced a spread over Germany up to 700 basis points. So Italy was paying on its, at some point in 2011, was paying an interest rate on its debt in the order of 7 or 8%. With a zero inflation, that's a pretty high number, and the market were worried about possible restructuring or default. So in November 2011, we have a new government that acted a quick fiscal adjustment, all based on the tax side, by raising the consumption taxes, real estate, and various other forms of taxation, no spending cut, and Italy entered in the, I don't know, the second or third or fourth recession, I lost count, but it continued to grow negatively until currently we are growing at the rate of 0.2%, which is considered a great victory. Ireland, on the contrary, after running a 30 deficit over GDP deficit in 1 year to save their bank, they started a fiscal adjustment all based on the tax side, on the spending side, namely cutting spending. And despite the enormous banking problem that they had, they actually restarted growth, positive growth, pretty quickly, almost immediately after the fiscal adjustment. The UK also did reasonably well, actually much better than predicted by the IMF. The IMF was actually, amongst many other things, was actually embarrassed had to admit serious mistake in their forecast of the UK economy. They did an adjustment based on the spending side, not as large as you read in the newspaper. If you go really and understand what happened, was actually much less aggressive, but they did quite well. Now Spain and Portugal did something. Spain and Portugal did something very drastic, both on the spending side and the tax side, and they had recessions, but they were also, in the case of Spain, the banking crisis was a pretty serious matter in addition of the fiscal adjustment. So the final point that has been discussed quite a bit are these cases of fiscal austerity more painful than in the past, or is business as usual? And one view, which is pushed once again by the IMF, particularly in a paper by Olivier Blanchard and David Legge, is that yes, we have learned from this crisis that the fiscal multiplier, in particular the spending multiplier, are larger than we thought, and we should be very careful in cutting, particularly in cutting spending. And the alternative view is that no, actually, this round of fiscal adjustment have not been particularly more painful than before, and in the case in which they have been more painful, like for example in the case of Spain, they may have to do not so much with the size of the fiscal adjustment, but may have to do with the nature of the fiscal adjustment and in other intervening policies like banking crisis and things of that sort. Now, I don't want to bother you too much with the detail of this, but at the end of the day, I think the answer is that there is not sufficient evidence to say that this fiscal contraction has been particularly costly relative to previous one. And if you take into account everything that was going on at the time, the basic result that is much less costly to cut spending than to raise taxes remain, and countries that have done it well have suffered much less than countries that have done it less well. Now, an interesting set of issues is that major packages of fiscal adjustment are never an isolated thing. They are never simply an action on this tax or that current spending. There are accompanying policies. One of them is, of course, monetary policy, and in particular, monetary policy at zero over bound. And could the ECB have done more? Probably yes. But the issue of the politics of the monetary policy, the ECB, and so on, is something that will be discussed later. Clearly, the ECB did not and perhaps could not act as the Fed because France, Germany, and Greece are not like Rhode Island, Massachusetts, and California in the United States for a variety of political and economic reasons. There was a credit crunch going on in many countries, remarkable in Italy and in particular, for example, but also in Spain. And so that has made things particularly difficult. And also there is this this matter of urgency because of this explosion, this interest rate created a matter of urgency. And when you don't have time, it's much easier to just raise taxes because it's like going to a cash machine and get money out of your population rather than engage in some structural spending cut. So as a result of all of this round of fiscal adjustment has been particularly painful. Also, in the case of, for some countries, structural reform require time. It required time for them to have an effect. Italy, for example, has engaged in a labor reform only now, which will have an effect certainly after. It would have been nice to have it. There was a lot of policy uncertainty that has made things even more difficult for investors. Typically what happened in successful fiscal adjustment, that investors get more feel safer about the state of the country, and there is a boom in private investment. We have observed that in case of previous fiscal adjustment. That may have happened less in some European countries because of the uncertainty. So the conclusion from which I find it, sort of throwing a few points that are sort of slightly less optimistic than Jeff, is that I think Europe is going through an exceptionally difficult time. Monetary union seemed to have increased rather than decreased the conflict among European countries. My colleague Marty Feldstein, when they created the euro, he predicted there will be a very large increase in conflict among European countries. European leaders, European economists were making fun of him, saying that he was the typical American that didn't understand anything about Europe. He was absolutely right, as almost always. And if you read an Italian newspaper, it's really horrible, actually, what you read about Germany, and it's quite really worrisome. Structural reform, so the pro-market reform are lagging in many countries. There is no interest in France in doing any kind of pro-market reform, and that is going to be an obstacle. And there is, again, what I think we can go into more detail later, but I find this obsession about the fact that it would appear that in Europe you cannot survive if government spending over GDP is less than 50%, and therefore taxation over GDP is not, there has to be at least 50%, which is becoming actually, I think, quite a burden for the growth of some of these economies. Thanks.
Very much, Alberto. Given that there was an inexorable or inevitable need for adjustment, would there have been different ways to do it? Jeff Frankel.
Thank you. So, I mean, of course, Alberto's right that we economists have been aware of costs and benefits all along, and that's sort of the way we phrase everything, is a trade-off between costs and benefits. I don't think Jeff would disagree with that. I thought I would start by talking about how the costs and benefits looked 20 years ago before the union, and how that's changed, how the costs and benefits look now, and then say a little bit about the path forward. I mean, I could also talk about all the mistakes that have been made along the way. Let's see. Let's start with the economic costs and benefits, and start with the economic cons. Two big ones. The one that the economic literature was overwhelmingly focused on was if you give up your own monetary policy, then you give up the ability to respond to idiosyncratic shocks, or what they are called asymmetric shocks. And that is what the optimum currency area literature is all about, started by Bob Mundell and carried on by others. And I think that's a case where those costs indeed have been very substantial. I think economists, especially American economists, had warned about them a lot and were right about that. So, for example, between Ireland, take that case, between 2002 and 2007, Ireland really needed a higher interest rate. They were in a housing boom or bubble. They were overheating. They needed a higher interest rate, but they couldn't have it because their interest rate was set in Frankfurt. Since 2008, a lot of the periphery countries have needed lower interest rates, but they haven't, at least initially, couldn't have it because their interest rates were set in Frankfurt. So I think that those predicted costs were right. The second one is fiscal moral hazard, and that's turned out to be sort of much worse than anyone expected. As far as economists go, it's worth recalling, we didn't talk much about this. Most of us, I think, as far as I'm aware, almost all economists were a little bit surprised in 92, when the Maastricht criteria gave such heavy emphasis to bringing down budget deficits and debt, as opposed to the criteria that would have been relevant from an optimum currency area viewpoint, which is labor mobility and the cyclical correlation of business cycles across countries and so on. And in fact, many economists reacted, if you're giving up your monetary independence, you need the fiscal independence even more than before. I remember, for example, a paper by Bauder and Rubini, and I guess Corsetti was the third author, about that. Well, I mean, I think you can give credit to the architects of Maastricht. They were onto something there, and it was a German taxpayer, in Germany shorthand for the surplus countries, that was forcing them to do that. They were really concerned that before this experiment of European monetary integration was over, we know you're going to have us bailing out some profligate Mediterranean country. And so they responded to that with the Maastricht criteria and later the Stability and Growth Pact criteria and the no bailout clause. Problem is they didn't work. They certainly, we know now they didn't work at all, but we actually knew that all along because the criteria were violated, and as Alberto mentioned, the spreads were virtually zero. Countries, I mean, Italy before 1999 had to pay a substantial spread. It was 7% then above Germany because of the not just the risk of devaluation, because when they borrowed in dollars, they had to pay a spread. That was credit risk, and that went away. I think everybody sort of, I don't know anyone who said, in retrospect, is so obvious, wait a minute, if these spreads are zero, it's not like U.S. states. U.S. states that spend too much have to pay higher interest rates. They're not doing that. There's something wrong here. The only thing the explanation could be, as Alberto said, that people think that the Eurozone stands behind these bonds, and that's not the way it's supposed to work. I don't remember anybody saying that. I wonder if any of my fellow panelists. So both of these cons turned out to be worse than expected. What about the pros, the arguments in favor? They're there. I mean, one was to eliminate inflation in the Mediterranean countries. I mean, that one succeeded, and, to the extent that we worry about the opposite now, which is deflation. That was the one that we economists were most focused on. The advantages, I think, was a credible commitment to non-inflationary monetary policy among countries that hadn't had that before. Promoting trade, as Jeff said, and the famous Andy Rose estimate of tripling. And I think that was a big motivation on the part of Jacques Delors and the other leaders who were doing, one of the motivations, who were pushing monetary integration. And we have gotten that. He mentioned the convergence of prices. It hasn't been anywhere near tripling, but there has been some promotion of trade. Third one, which Jeff also mentioned, was avoiding competitive devaluations, and he gave us the example of Mercosur. All in all, as I go through those lists of pros and cons, I'm struck by kind of the balance seems to be less favorable now than I think a lot of people thought 20 years ago. As Jeff said, that leaves the political arguments, political or political economy, and that's certainly very important in understanding why the European countries went ahead and why there's still so much support for it. I mean, the world doesn't really divide into economic arguments and political arguments. There's sort of a continuum, and there's one that's kind of in the middle are the arguments that joining the euro will force these countries to undertake structural reforms that will, things they maybe should do anyway, that will make them, will improve their economies, such as more flexible labor markets. I would say that one didn't work. I mean, you have some cases like the Germans, the Hartz reforms, but I don't think that was really because of European monetary integration. And then you have examples like France that sort of move the opposite direction with the 35-hour work week. I mean, I guess now, under very extreme pressure, Italy and Greece are forced to do reforms. But boy, this is pretty extreme, and I don't know if anybody would make the argument that you know, the reforms that we've got now were so important that it was worth going through this crisis just to get them. Well, who knows? When, you know, maybe we'll look back on it, and that will turn out to have been the case. I'm not sure. The one place where this argument does really work is the aspirants from the periphery, Central and Eastern Europe, before they join. I mean, once you're in, it's all over. But as Jeff mentioned, there have been 6 countries who have joined even since the crisis, and in many cases, they have done really important, useful reforms, and they probably would have had it harder, less likely to do it if it weren't that. So the condition, as a condition of getting in, I think that one did pay off. Then to move into pure politics, when you think about these countries, certainly when you think about the Baltics and how determined they were to join and what a high price they paid. I mean, they had the worst recessions in the world in the global financial crisis, Estonia, Lithuania, and Latvia. And I think it's pretty clear that their motivation was largely political. We will do anything to bind ourselves to Western Europe because we're afraid of Russia. And one has to say that was a pretty valid fear. I mean, relative to what we would have thought in the past, they were not being paranoid in that. So on that one, the payoff looks, the advantages look stronger. Also on pure politics, Alberto has already invoked Marty Feldstein, and it really is true. I mean, it was sort of overstated. He never said it would lead to civil war. But I mean, he was quoted. All of us have had the experience for 20 years of going to conferences in Europe and being on this subject, and people saying, "What about that Marty Feldstein? He says it's going to lead to civil war. He's crazy." He never quite said that. There was a headline that the Foreign Affairs put on his article, but he did say, one thing he said was, which was, it's a good point, a common currency did not prevent the United States from having a civil war. True statement. But he also said that it would lead to increased conflict, and the irony, of course, is if the whole motivation is to avoid conflict, whether it's military or just political, if that's a major motivation, and I think it was, particularly thinking of the previous 100-year history between Germany and France, it is sort of ironic that his prediction turned out to be right, at least if you're talking about the relations between Greece and Germany or Italy and Germany. Whoever thought we'd be hearing about the World War II over again in this kind of context. I'm going to skip over. I think it could have been done better. I don't think it was doomed to failure. I have we've all been giving on panels like this over the last 5 years, and my first time I did it, it was the big mistake that they made in enacting it, and then I had one talk called the 3 mistakes they made, and then the 4 mistakes. I mean, they keep making mistakes. I'm up to 7 mistakes now, but and the monetary and fiscal austerity are in reaction are some of them. But maybe I'll just take a few more minutes to look forward where we are now, because I think that's kind of what maybe people are most interested in, especially if you've heard a lot of these panels before, then have heard the arguments before. And Greece in particular, I think the new Greek government could have played its hand much better. And the fact is, Greece finally, after all this pain and et cetera, has been running a primary budget surplus. And that should put it in a much stronger bargaining position. It should be able to say, to a limited extent, it should be able to say to the northern countries, screw you, you want to roll over your loans? Great, do it. If not, we'll default. It's all up to you. And that's a pretty strong bargaining position. And they didn't do that. I mean, exactly. They acted nasty on other dimensions. So the kind of obvious deal is we're not going to run a 3% primary surplus. That's too much austerity. We'll just run a tiny budget surplus and ease up on the austerity. That would be the first part of the deal. Second part is the Troika, if you want to roll over your loans, do it. The IMF. If you don't want to, don't do it. That wouldn't be said publicly, but and then they would have to do it. They would have to do it. But the weapon that the Troika countries has is we don't have to, and that they have been exercising, we don't have to support your banks. And we can allow the withdrawal of deposits to accelerate, and then your banking system will implode. And Greece needs that needs that support. And so what they should do is say we're going to stick with the other reforms, the labor market reforms. We are going to pursue those. We're not going to reverse them, but we're going to see them through. That's a package that seems to me that they should have done, and still could do, and there's a good chance they will do some version of that. If not, if it just breaks down, I just to speculate, I don't see Greece leaving completely. I see them taking a time out, putting on capital controls to prevent the money from leaving the banks. That's what they would do to protect the banks. Putting on capital controls, having an alternate euro. I don't think you'd call it a drachma. It would be like the secondary market euro. I mean, sort of like what Cyprus has been doing, and with the idea that we'll come back in. We're taking a sabbatical. What would they call it? We're taking a breather, and we'll come back in someday. But I probably used up my time.
Thanks a lot, Frank. Jeff, Dick.
We're at the Center for European Studies for many years, decades, influenced by Stanley Hoffman, so I'm going to make 3 points. The first concerns the rationale for the euro, inevitably some overlap with what the two Jeffs have said. The second concerns Germany's role today, and the third concerns Greece's options today. I want to remind, and some of these have been mentioned, but it's useful to keep in mind things that are happening contemporaneously when decisions are made. Europeans in 1986 decided to create not just a common market, but a single European economy, single European entity, with a target date end of 1992. It was in that context that the Maastricht Treaty was negotiated. And the judgment was, and I actually share it, that we cannot have a full economic union with flexible exchange rates. That involves a whole set of separate discussions, but I think that was actually a reasonable position at the time. It was reinforced, and that is not mentioned anywhere these days that I can see, by the complications created for the common agricultural policy of changes in exchange rates, not just floating rates, but even changes in fixed exchange rates. And it was especially the German farmers who complained because the common target prices were set in ECU, and every time the German mark appreciated against the ECU, it meant the target price measured in German marks, horrors, would actually go down for German farmers, and German farmers did not like that, and the German government reflected the view. So I think the operational question, and common agricultural policy was absolutely at the core of European integration, going back half a century. We don't pay so much attention to it now, but it was absolutely at the core of European economic integration. And so this was a very operational question for the common agricultural policy. And third, there was the assumption, again I think correct, that a common currency would greatly reduce, or at least measurably reduce, transactions costs across national borders, and in doing so, increase competition, which was an important component of the single European market. And so for all of these reasons, on the plus side, I think there's a push for a common currency. I think that the optimum currency area, if I may say so, did not enter the European debate at all seriously. That was mostly an artifact of academic economists taking it up. And of course the academic economists had some merit in what they said, but it needs to be mentioned, most economic models assume zero transactions costs. So when you get into formal economic modeling, one of the main alleged benefits of a common currency just doesn't show up at all, by assumption. By assumption. Anyway, that's by the by. Germany. And as Hans-Helmut will remind us, and so to avoid him having to do that, Germany has some company But I'm going to talk about Germany. Germany has some company in Finland and the Netherlands and in actually some people in other countries, including Italy. But the Germans apparently do not understand the way a common currency area must work. Because it means for a country in the position of, or if they do understand it, they reject it. But a country in Germany's position in recent years must inflate. And of course, inflation is a terribly sensitive issue in Germany. But it is an implication of a country in surplus in a common currency area that the country should inflate. It's a proposition that goes back to David Hume over 200 years ago, referring to a gold standard, but this is a kind of gold standard without gold. And that creates a tremendous tension in Germany. I'm stepping way outside my area of competence, but Germany's identity seems to be very strongly linked to export performance. Competitiveness is a buzzword actually everywhere in Europe, not only in Germany, but it is especially a buzzword in Germany. And by competitiveness, at least senior German officials, I can testify from personal conversations, mean unit labor costs. And they do not want unit labor costs to go up. Unit labor costs have to go up if Germany is to play its role in a common currency area. I mean, it's just part of the role. Unit labor costs have to go down in Greece, but for symmetry, they should go up in the surplus area. And not to recognize that role, and indeed to do many things against it. Germany moved its budget into surplus this year, and the one German representative on the ECB opposed monetary expansion. So the Germans on a variety of fronts are actually strongly resisting the implication of being in a common currency area. I'm told, I actually haven't gone back to check the documents, I'm told that the Bundesbank in the 1990s, after Maastricht but before the euro was introduced, had a lot of materials made available to the public about the implications of being in the common currency area. And I assume the Bundesbank got it right. It's the kind of thing they would get right, but apparently it wasn't absorbed by at least the German political class and the German public. So Germany, with some allies, is creating an overall macroeconomic environment that makes it very, very difficult for the southern countries to improve their condition. This is not a question of lending more to Greece. This is a question of the overall macroeconomic environment just making the situation in Greece much more difficult. What can Greece do? My third point. Greece now has very limited options. Jeff has suggested what they should have done, but that's to some extent water over the dam, although perhaps they can recover. Greece now has a current account surplus thanks to the depression in Greece, and exports have actually increased significantly, although not as much as some people would have hoped. That means that Greece as a country, as an economy, is no longer dependent on net inflows of capital as it was for many years. That's the positive side, but the Greek budget is still in deficit. Jeff emphasized the primary surplus. The difference between a budget deficit and a primary budget deficit is interest payments. And Greece has a lot of interest payments, even though many interest rate concessions have been made to Greece by the European lenders. And so Greece is in budget deficit, and it's running out of money. I am not well informed on exactly when they're going to run out of money, but they're without new loans from somebody external to Greece. The Greek government is going to run out of money.
I heard May.
Pardon?
I heard May.
May. Well, there are different figures. It's a little bit like the U.S. debt ceiling. There's a certain elasticity.
Yes.
The treasuries can play around a little bit. They have some flexibility. But the question is, what is Greece to do? And people are talking about Greece's exiting the Eurozone. My own view is that would be a terrible mistake for some of the reasons that were implicit in the other remarks. I think that Greece can change the profile of its pain. And Greece's pain, if it were to exit the euro, will probably be a lot less 5, 6, 7 years from now. But Greece's pain in the next 2 or 3 years is going to be much worse. And the reason is there's a lot of external debt in Greece. It is denominated in euros. If Greece were to exit the Eurozone and introduce a currency which is depreciated against the euro, Greek legislation can take care of internal debts, awkwardly, but it can be done, cannot take care of external debts. And many Greek firms would go into bankruptcy as the debt measured in a new currency rises sharply, depending on the amount of depreciation, but their income doesn't rise correspondingly. And again, economists like double differentiable functions. We don't like discontinuities, and so most of our modeling doesn't allow for discontinuities, but bankruptcy is a terrible discontinuity. And to have many Greek firms go into bankruptcy would be extremely disruptive of the economy for a while. I mean, it would eventually recover, presumably, but it would be disruptive for a while. So I think the solution for Greece, assuming the Europeans don't put up any more money, is to pay their employees, and the payroll budget of the Greek government is very high, in vouchers, IOUs. Partially, it doesn't have to be completely, but it doesn't have the euros by assumption by mid-May or whenever it is. And I think they should go to a voucher system, pay certainly the public employees in vouchers, or at least partially in vouchers, maybe pensioners. It depends on how much they have to do. And either allow a market in vouchers, or even if they prohibit a market in vouchers, one can be confident that one would emerge, and the vouchers would sell at a discount to the euro. But formally, Greece would remain in the Eurozone and avoid all of the balance sheet problems which would arise from leaving the Eurozone. And then over time, Greece could do whatever it wanted to do at its leisure, and with the objective eventually of having the parity restored between the vouchers and the euro. The vouchers would all be denominated in euros. Jeff, in his recent book, has described an analogous period in the United States. The U.S. actually issued vouchers during the Civil War. We called them greenbacks, and we suspended payment into silver and gold. And after the Civil War ended, it took only 14 years to restore the parity of the greenbacks and gold. It was done, and it was done with some pain, as Jeff describes in his book, but it's all doable. Whether Greece, in addition to that, should, as Jeff number 2 suggests, stop payment on its external debts is a question that I can't address, partly out of 2 classes of ignorance, one of the numbers and the other of actually regime. So I'm going to ask Hans-Helmut to speak with some authority on what would be the implications for access of the Greek banks to the ECB if Greece ceased to pay on its sovereign debt, pay interest on its sovereign debt, because that is a critical issue, I think. The Europeans have tried very hard over the last 4 years to separate banking issues from sovereign debt issues. They have not completely succeeded. That's a work in progress, but it becomes a very operational question for Greece. And so maybe Hans-Helmut can tell us what about the eligibility of Greek paper if the Greek government were to cease paying interest on its debt. I guess the only thing I would add, and it's consistent with what Jeff said, is that I think in this process of introducing vouchers, the Greek government would have to put limits on withdrawals from the Greek banks, as Cyprus did. They had, at one time, 300 euros a day was all you could withdraw. We know that withdrawals are already taking place, or at least they did last month. from the Greek banks, and one can imagine as the date approaches of no deal, those deposits would be withdrawals would be accelerated, and so I think Greece will have to put some limits on cash withdrawals, well, withdrawals in general from Greek banks. I don't see a practical alternative to that, given the situation that Greece is now in. Thank you. But maybe Hans-Helmut can tell us about this. This is a technical but actually extremely important issue.
Thank you very much, Dick. So eligibility used to be decided upon having at a minimum an A- rating. And the criteria for eligibility have been reduced over the course of the cycle, over the course of the crisis. And ultimately, in the case of Greece, Portugal, and Ireland, it was decided that the main criterion for having access for handing in government paper in order to get central bank liquidity would be to be under a program. So that's the condition. Now, in case that Greek would not remain in the program, which is currently a threat, the ECB has thrown the ball into the court of politics. They've told the finance ministers they would stop funding them unless they would get a backup from the Euro group. In terms of your precise question, the very long answer to that would be no. No more eligibility. But
That's so. This would put the Greek banks in jeopardy, in serious jeopardy.
Plus,
so that's an argument against not paying interest.
Plus the insurance sector. So
the financial sector,
the whole
right.
financial industry
Right.
would implode. And given that scenario, I cannot imagine that the Eurogroup would just accept that. So Greece will not drop out of the euro by accident. So Brexit, in terms of accident, is a nice metaphor, but deeply flawed.
Right.
If it would happen on purpose. And as current cost and benefit calculations are, one cannot be nonetheless be assured that something bad will not happen. So I was wondering, given the 3 points which Dick raised in line with Stanley Hoffman's suggestions, shouldn't we in particular talk about or discuss the latest two of those points on the panel and then go into the audience? So one point was about how can we get Northern Europeans to become macroeconomically more accommodative? How can we get Northern Europeans to stay away from their idea about fiscal soundness in order to ease the pain of the South? Is that a plausible option? Do you have any views on the panel on that? Why are they misbehaving, those Northern Europeans, the way they do?
Look, I mean, someone said culture. There is a sense in which the Germans are entitled to their morality tale, which is this is what they were afraid would happen, and they were assured it wouldn't, and it did. I mean, so on that level, I can understand it completely. And I'm not sure what.
We're talking about German fiscal policy, not loans to Greece.
Well, I'm talking about fiscal policy. Is that what you're talking about?
Fiscal policy.
Yeah.
And wage policy.
Yeah, and
Because
not loans to Greece. That's the morality tale.
Well, I think the morality tale also applies to monetary policy and fiscal policy. You're right, but it applies to all. It applies to all three. I mean, part of it was we know that you're going to weaken the. You promised that the euro is going to be as strong as the Deutschmark. We're afraid it's going to be as weak as the lira. That was what they were afraid of. And
to put it differently, I mean, you're certainly right from an economic point of view, but politically, suppose you're going to sell the a German that it is just as much your fault because you've been so productive and so keeping your costs so low, you're just as at fault as the Greek guys who are avoiding taxes and not paying, getting salary increases for doing nothing and all of that, and you have to compensate the two. So
No,
that's really hard to sell.
I'm sorry. Germany had an internal devaluation in 2007, just not long before the crisis. It reduced its payroll taxes and it raised its value-added taxes. And that's an internal devaluation to reduce labor costs in Germany relative to its European trading partners. So Germany is culpable in creating this imbalance. The first point. Second point is German banks were heavily involved in making loans to Italy and Greece and other countries. And in fact, it is said, again, I don't know what the numbers are, it is said that the reasons the Germans were reluctant to, and France also, to go to the IMF, which has a long history of debt restructuring, was to protect German and French banks, which were heavy holders of Southern European debt. So the Germans, I'm sorry, are culpable in the build-up to the, but that makes a morality tale out of it, and I don't think one should approach economic policy as a morality tale. That's who did what, when, and so forth. We have a problem now. How can we solve
I was talking about you didn't understand me. I was talking about politics, not economics. I'm talking about the German. I'm talking about the German chancellor telling the Germans what you're saying, and it will be laughed out of the room. Probably.
An honest German chancellor would say, we are implicated in this crisis for at least the two reasons I mentioned.
But it is also true that they productivity increased and they did the labor reforms and
their productivity increased by 30%. I mean, whatever it is, in Portugal it dropped and in Greece it dropped. So it's a very hard argument.
But on the other hand, I think they have some right points. On the other hand, I believe, unlike the Germans and unlike Alberto, that fiscal contraction is contractionary. I mean, that we have to I'll let Alberto explain his beliefs. But I do think there's been too much fiscal austerity. I agree with him that the problem should be viewed as pro-cyclical versus counter-cyclical. The boom was the time, as Keynes famously said, the boom was the time to run surpluses, and the recession was the time to loosen up.
Said that too.
Yeah, he did. He said that. In terms of policies, what Germany should do now is spend money on infrastructure. I mean, they should undertake
I
the
think they
fiscal
should cut
expansion.
tax. I mean, what is this obsession with infrastructure? I mean, there are more highways in Germany than just cut taxes. But what is this obsession with European side with infrastructure? I mean, let's spend it takes longer to go from Boston to New York than to go.
Well, we should too. we need it too. I mean, Nouriel Rabini was here last week, and he said that German roads are worse than American roads. And after a winter in Cambridge, I think that's going too far. But we all need it. We both need it.
But could we just look at the facts?
Why should we?
Before jumping to a conclusion. The first is wages. German labor unions have been ferociously talking against what the head of the economics department was saying 2 years ago when he said in a parliamentary hearing that wages should increase more rapidly. So it have been German labor unions who've been opposing that. By the way, they've also been against minimum wages until 2011 because there was quite substantial reservation wage which came out of social assistance, social security. So endogenously, labor does respond to what is going on at the corporate level, but they don't overdo it. And how would you how can you get this out of the system? This is they are responding very flexibly to what is happening at the corporate level, and the macro result is possibly wages which are not growing as rapidly as you would like to see them. By the way,
sure.
and then
Can you explain that a little more? Because
then I stop on that, Jeff. Do you have any idea how high German wages are in manufacturing industry? 40 euros. Any idea what the wages are here in in Boston, 24. So you're not talking about an economy which is, we still have unions in Northern Europe who are quite important. So even if one would share your diagnosis, which I do, I don't know how to implement that on the micro level, because it's not the chancellor who decides on that. By the way, even the finance minister Schäuble said about a year ago that wages should increase more rapidly. And this is not Germany, it's the same going on in Sweden, in Denmark, what have you. Second point concerning infrastructure, Nouriel Roubini is often very right and at times very wrong. Infrastructure in Germany is of course not bad, but we have been underinvesting for 2 decades. So net capital expenditures have been negative. In fact, we now even have bridges between Mainz and Wiesbaden, which have to be shut down, which is unprecedented. But again, it's an issue of implementation. 60% of capital expenditures in the case of in the German case are done on municipal level. It's
Municipal or land?
Municipal.
Municipal.
Municipal. And there's a high dispersion in terms of capacity of those municipalities to fund infrastructure projects, because they do have a sensible budget rule, which means they're only allowed to go into capital expenditures if they run a surplus in their current account, which allows them to service the debt. So you would need from the federal level a boost to that. What they are now doing is they'll give 5 billions, which is not much more than peanuts, to increase infrastructure expenditure. But it's not as easy as one would assume, that there could be a major boost from the federal level to do that. So in both cases, even if one shares your diagnosis, it's very difficult to implement.
But how about Alberto's preference of reducing taxes? Would that be difficult?
Yes, but not for implementational reasons, but for reasons of philosophy. The big argument is...
well, no, come on, Helmut, you can say, I mean, if
Alberto,
everything is impossible, either for philosophical reason or for political reason or for organizational reason, then...
No, Alberto, the point I wanted to make is the government is proud of having what they call a plaque zero. So they do not understand in any way what the Jeffs and you were saying about automatic stabilizers, about a cyclically appropriate budgetary policy. They are shooting for zeros. Zero deficit is the criterion for success. So how do you get around that? Well, you have to educate the German public, possibly, the median voter. But the government won't reach on that. In fact, we now have a debt brake in Germany, which in particular will inflict or will make it impossible for lender to do the investments that they used to do. So I'm afraid pretty skeptical perspectives on all your propositions.
Well, this is just another way of what I said earlier, which is that Germany doesn't understand. Germans do not understand. The German political elite do not understand the implications of being in a common currency area.
You know, isn't it deeper than that? I mean, what I think.
Well,
what I
you
think
could
I've
call it
learned,
deeper than that,
no, I mean,
but I consider that pretty deep.
Forget this. I think I have come to understand something I didn't understand before, which is that, I mean, in the West, we try to avoid the word Keynesian because it sounds old-fashioned. But the truth is, our thinking. I mean, we know there's other arguments. We know that there's a tendency for governments to get too big and to run deficits at the wrong time. We know all the arguments on the other side. But we all, I mean, both economists and I think the general public, at least mostly, has a notion of Keynesian economics, what it means to moderate a recession by a more expansionary fiscal policy. I guess. I mean, Keynes, after all, wrote in English, and I guess that doesn't exist in Germany. That idea, people aren't even aware of it. Is that too strong?
I do agree with Dick. They don't understand it, but it's unfortunately not German only. if you would be the fly on the wall in any ECFIN meeting, the strongest views in that regard wouldn't come from the Germans. They do come from the Finns, they come from the Poles, they come, so that's a view of the world which appears to be bizarre to you here. It is, in my eyes, bizarre also, but largely shared in Northern Europe.
But I think though, I mean, to answer Jeff, I think the answer to your question is this. I'm not sure if they have not read Keynes or not, but I think there can be a slightly more sophisticated argument than that, which is there is a, and Jeff, correct me if I'm wrong, but there is a very established political view that says, okay, if you allow countries to follow Keynesian policy, they're very happy to run the deficit during recession, but when there is an expansion, forget the surplus. So Keynesian policy would mean deficit after a deficit after a deficit, which is exactly what happened, by the way.
That's a legitimate point, and that I understand, and that I think is largely why Keynes got, sort of fell by the wayside and got discredited. There's a lot to that, I mean, my way of saying it is you want to be sure to have institutions and understand the point about counter-cyclical policy, because if you just always expand.
Well, it's easier said than done.
But do they, right, and we've all thought about that, and there's a lot to say about that, but I wonder if, I mean, I don't want to sound insulting to Germans, but whether they even understand the point, or even have a space, if they understand what we're saying, even to disagree with it.
But I think the point for this forum and others that have taken place is that the euro area may actually break up, and it won't be mainly because of Greece. It'll be mainly because Germany cannot accept the rules, the implicit rules in a euro area. And that has implications, as Jeff Frieden suggested, that go way beyond just the common currency. Just to start, German farmers are going to start complaining again against the cap as the German mark appreciates and reduces their target.
Well, by the way, if they have to destroy the cap, that's the best argument. Best argument I've heard. When I heard that was one, and you're right, 15 years ago, this was one of the big arguments. I thought, if that's the argument, don't do it.
So on that positive note, we might open to the audience. Yes, please.
I'm wondering, you said about these micro problems of adjustment. I think in some ways it seemed like, well, we can't do it because of this. I'm thinking that they should do it all the more so because of this. There's an addiction to importing, getting demand from elsewhere. And you can see that addiction in those very structural problems of adjusting. But if it continues on a policy of being dependent on external demand, it's only going to reinforce those very problems and make them worse in the long term. And I'm thinking about the secular stagnation, savings glut in the world. Southeast Asia, China, Japan, huge surpluses. The United States, the opposite. But Europe was balanced, not internally, but at least externally, and it's no longer. Germany wants its surpluses, and it wants the South to have surpluses before, and those surpluses had been imbalanced internally, at least with those southern deficits. Now they get like a $300 billion surplus. Who are they gonna export to? The U.S. again? That's going to lead to a lot of problems. And the idea of deficit being a problem, but most of these places have increased taxes and cut the government, and the debt. And if you got 30% of your GDP gone, who cares about? Your debt burden is increased. So the thing is, there really a lot of problems. The U.S. has to adjust. China's trying to adjust, but Germany has to adjust too. And Europe's, where they're going to export to. The U.S. can't go back to what it had been.
Sure we can.
For how long, though?
Americans love to consume.
Yeah, that's what we do best.
As I've said, Americans are the consumers of last resort.
Yeah.
Stu. Oh, and just quick.
Thank you.
Like a fire hydrant.
I don't know whether that's a deep or a shallow explanation for the Germans, but they live very comfortably with their export surpluses. And where I agree with Richard Cooper is that Germany still runs its policy as if it's just its national, in its own country and a small country and an emerging market and so on. Mentality. But I wonder if one would like to know a little, and I think that's what Jeffry Frieden would find the most obvious thing why governments do that. As long as there is no accountability to anybody else than your national electorate, it is hard to change that. But I would ask the panel, why do capital movements not do what they did with the south of Europe, namely lead to their real exchange rate appreciation and the current account deficits and all that? Should we not hope that that will change something? Housing bubbles and the wage demands will then rise with that, because you can't live in Frankfurt anymore under these conditions, and so on and so forth. And further on that, I mean, a bit drawing on the American experience, Jeff Frankel, you said earlier, you know, there were high costs of the monetary union. We saw it with Ireland. They couldn't raise the interest rate when they needed it. Well, the interest rates were low in other countries too. What prevented the the Federal Reserve to raise the interest rate when there were housing bubbles here?
It did.
Or Richard Cooper.
Raised it to 5.5%.
But the
And
housing bubbles
remember,
did happen
Greenspan's
here.
conundrum, which was they raised short-term interest rates very sharply, and long-term interest rates didn't go up. And the one-word answer to that is China. I mean, it's more complicated than that, but excess savings in the world kept long-term interest rates down. The Federal Reserve raised interest rates very sharply.
I mean, the ECB was always accused of raising interest rates while the Federal Reserve kept it lower than that. But the question finally to you, again, drawing on the US experience, how would Alabama have to inflate if all the automobile workers manufacturing shifts to Alabama from Detroit, and Detroit is suffering? How would you then tell Alabama to inflate if you say that's what the Germans should do?
Well, we have a live example. On the last point, we have a very live example right now, and it's called North Dakota. North
a year
Dakota
ago.
just went into a tremendous boom because of shale gas. And North Dakota is a lightly populated state, not enough accommodation. So wages have gone way up in North Dakota. Property prices have gone way up in North Dakota. That's exactly what you'd expect in a currency area. As one area booms or another area becomes depressed, you expect these wage adjustments. And of course, we didn't mention that you get migration. And so part of that would be migration from Greece and Italy into Germany in the European context. But that's exactly what we see in the United States. And
You're talking about North Dakota 10 months ago, but
Huh?
you're talking about North Dakota 10 months ago.
I'm talking about
Right.
North- Well, we have, I don't want to get into the questions of Detroit. Part of it is wage rigidity, downward wage rigidity, which is related to the Automobile Workers Union, and the fact that Alabama and Tennessee are not unionized, and so there's a wage discrepancy which persists even though unemployment is higher in that part of Michigan than it is in other parts of the country. So that has to do with institutional rigidities, which are overcome, but it takes a long time to do it.
Yeah, I just want to, I mean, I could, this has been such a rich discussion, I could talk for 45 minutes about different aspects of it, but
Please
the
don't.
one, I won't. Don't worry, Alberto. The one thing that I want to do is you know, Alberto was introduced as being a professor of political economy who does political economy. I've heard no political economy from him or much of anyone else, so I want to try to inject some of that, which is to say that in some sense, you know, this is not an optimistic view. In some sense, political economy is the true dismal science, because what it says is whatever should happen, what's happening is what has to happen given the political balance here. Some of that would apply to some of the things that Alberto was pointing to, and we can come back to that. But on a couple of the points that have been mentioned so far, I would say the morality story that people have referred to is a politically constructed morality story. There's no reason why it's any better to be an irresponsible lender than an irresponsible borrower. But the German government constructed the public diplomacy of the crisis in such a way as to lead the German population to believe that this was about bailing out lazy Greeks as opposed to bad German bankers. So there's a political economy story here that underlies a lot of the subsequent politics of the crisis. That then goes to taking it a little bit farther to the point that Cooper was making. is that in my view, to understand the German position, you have to understand that the political economy of Germany has been really since the war one of generating a continuing series of export surpluses as the engine of economic growth. And there are a whole variety of socioeconomic and political and policy conditions associated with this. We read our Emiger's memoirs, he talks about this constant pressure from the exporters, everything that was done in monetary policy, whatever he did that led to even a slight appreciation of the Deutschmark, he'd get pressure from the exporters. And that's, whatever you might say about what should be done in Germany, the fact is that the export sector is extraordinarily powerful, maybe culturally powerful, maybe politically powerful, maybe powerful in some other ways. You can call it whatever you want, but German policy is dominated and has been dominated by the general consensus on the desirability of generating export surpluses, which is seen as the engine of economic growth for Germany. Now, that's my interpretation of why we stand where we are. If you want to ask, could it change? I would say that the principal source of pressure for change would be a recognition, as Dick also pointed out, that in the final analysis, Germany's future almost certainly cannot be divorced from that of the European Union and the Eurozone. The principal source of economic growth in Germany between 2001 and 2007 was exports to the Eurozone, right? And it is hard to imagine that if the Eurozone or the European Union breaks up, that Germany will be unscathed. So if you want to think about a political economy angle that suggests how the German public or the German political elite might be led to move in a direction towards a more constructive resolution of the crisis, which in my view would involve a restructuring of not just the Greek but other debts and some cooperative measures along those lines, it seems to me that you have to say there is a Pareto improvement available, and that Pareto improvement is one that benefits both Germany and its partners within the Eurozone. It's a very difficult argument to make. It is not one that's popular within Germany, but if things continue to spiral downward, it may become a politically viable position within both Germany and the other Northern European countries.
Carl?
I'd like to add a little point too. I very much agree with what you said, Jeff. Just a side point on Dick. Last year, Germany became the second largest immigration country after the United States, net, 450,000. Most of them actually European Union. So something is happening.
Right.
What you were referring to. But I think, Jeff, you're quite right. I see it the same way. The political discussion now in Europe and the constellation of forces and also the constellation of power is such that whatever happens, Germany is going to be made responsible. And I think that is dawning on the German political elite. And when you look at the political discussion, it's quite clear. Merkel has no choice but to save the euro. There's no choice. And the way the Greeks have run this whole thing, again, adding on top of it a political argument, the German debt, the German responsibility for World War II, adds another argument on that. So I think things are going in that direction. Whether that will solve this discrepancy of cultures and understanding that I think we refer to, and I think it's quite right, I doubt it. But it will at least do what you said. I think it will just mobilize enough resources to do another round of helping the Greeks. But it will be a tremendously difficult task internally, because she needs the parliament for that, and she needs the constitutional court, and that is both are rather difficult. But still, I think at the end of the day, they will do it, because fortunately Germany has a great coalition at the moment, and that makes it much easier to do it in the end.
Maybe we should stop with a couple of brief conclusions.
Yeah,
concluding
I wanted to
remarks.
say something. Actually, I agree with what you said, with sort of unrelated to the last point, but there are 2 points I wanted to make that I read down before I forget, or before we close. The first one was that when Jeff, I forget which of the two Jeffs said something about something about the accumulation of mistakes, that every 5 years we have a meeting with small mistakes, and I think that if to summarize all the mistake, I mean, I think there's one critical mistake that the construction of Europe did, which is let's agree on what we can agree, and what we cannot agree, let's sweep it under the rug. And if we're at A, B, C, we have to agree on A, B, and C. Let's agree on A, forget B and C. But in many cases, if you don't have B and C, A doesn't work. And therefore, we got the euro, but we didn't agree clearly on the fiscal issues, and so that became a mess. We didn't do the banking union, that became a mess. So I think that would the mistake that underlies everything else. I think it's this one. And the second, when we have this roundabout and we talk about Greece, and we spend so much time talking about Greece, I wonder that's an example of I mean, what I find it crazy that the size of Greece is the size of Rhode Island in the United States. Okay, imagine if we were having a discussion about the United States is about to fall apart because in Rhode Island there was corruption, as there is, tax evasion. They were.
Right.
You mean it was Rhode Island?
Rhode Island was the problem. Yes, absolutely. Absolutely.
Well, I think that the coverage of the Rhode Island crisis in 1976 is not even close to the coverage of the Greek crisis today. So it's an interesting observation, but the size of the two things are not quite comparable. So the idea that Europe is falling apart because of such problem, it means that it suggests an incredible inability of the European leadership to deal with reasonably small crises. And I'm not saying whose fault it is not, but the fact is Europe is about to collapse because 0.2%, 2% of appeal of the and that suggests that there is something. The last final point is that the idea of international. I mean, Europeans are obsessed about the distribution within their country, but when it talks about when it is an issue redistributing from one country to the other, they become completely frozen, and so redistribution across countries is another issue that has been swiped under the rug and is coming out in the discussion about Greece.
Dick?
Dick, you want to go
Dick,
next? Or?
any further?
No, I've said too much already.
No, not true.
Should I go? So maybe on my list of the mistakes, one of them is the one that I think really could have been different and handled differently was 5 years ago, exactly 5 years ago, when the Greeks announced, well, it was the previous fall that the new government announced that the budget deficit was far higher than expected, and then we've got a problem. What do we do? And the leaders, I'm agreeing with Alberto, this failure of leadership. The leaders of the euro swept the problem under the rug. The obvious thing to do would be to say we've seen this before. It's like Argentina. It's all these other emerging market and currency crises, debt crises, and banking crises we've seen in the past. They should have gone to the IMF, and I think there should have been some restructuring of the debt. They said, "Oh no, we're different. We're not. This is within Europe. We wash our own laundry, and we're not emerging market countries. And that would be to do that. We have to admit that we're not a fiscal union." And they should have admitted, and there'll be contagion. Well, all those problems were much worse. It got much worse. The level of debt to GDP ratios got much worse. The spreads got much worse. They lost all their credibility by trying to postpone it instead of saying this is a great opportunity. We always knew that at some point there would be a problem. This is a great opportunity to set a precedent. Thank God it's such a small country, because two reasons why Greece was the perfect precedent. First, it's small enough that you could have insulated the banks that hold the Greek debt, the ones that were solvent. You could have insulated the rest of the euro system against it. And two, they had been pretty egregious on violating the criteria. I mean, I don't think it's Germany's all at fault. I think Greece there's a lot of fault in Greece, and so it would have been a perfect country to make an example of. It would have been You ask, why does the U.S. system work? Why, no matter how much Illinois screws up on its pensions, or Detroit or California, why does nobody expect the federal government to bail them out? Why is there no moral hazard? I think more than anything, it's because in 1841, when 6, 7 states, eight counting Florida,
8 states and a territory.
8 states and a territory had debt problems and went to Washington and said, can you please bail us out? The answer was no. And that set a really important precedent that's with us to this day. And I think that the big mistake is that the Europeans didn't seize on Greece as a perfect example to do something similar. One more comment. I think we're here in some sense because of Jeff's book, Currency Politics. And so if you had a copy to hold up, I haven't seen it yet, but my blurb is in the back.
You have a copy? You didn't get a copy?
I didn't get a copy.
You're not going to get a
Anyway,
copy.
I believe my.
I bought my own.
I believe
I bought my own.
I believe my blurb is on the back, and
It
this is
is,
not.
yes.
This is not one of those recommendations.
That's my publisher.
Because you do because a friend asked you. This is because I read the book, and I do recommend it
Okay. Thank you, Jeff.
heavily.
I'm going to take away all the criticism. I wasn't going to criticize that. So actually, one thing I was going to say is the 1841 non-mutualization of debt was the second time. And in 1789, the new government under Alexander Hamilton, my hero, the most economically literate of the founding fathers, assumed all of the defaulted debts of the states to establish the creditworthiness and the reliability of the federal union. Now, I'm not sure that's a lesson for the Eurozone, but it is important to recognize that the reason there was this moral hazard was that the assumption worked to create a credible federal union. It did create a moral hazard problem that was then resolved with the non-recognition afterwards. That's just
Not so well known is that he lowered the interest rates on all. He assumed them at full face value, but he lowered the interest rates on all of them.
Very dramatic. Big haircuts.
So they took
Big haircuts.
They took a big haircut.
Big haircuts,
That's
absolutely.
not usually told.
But the
The Europeans were that Obama was on the phone when the May 2009 summit happened, and the Europeans had to decide whether we let Greece fall or not, and urged the Europeans not to let a second Lehman moment happen.
Yeah.
I mean,
Right. I was only going to try to re-emphasize the political economy point, which is that we can bemoan all of the terrible things that have happened, which we should, because bad things happen to good countries and good European unions and things like that. But I think if we're going to, it's not the only way, but one of the ways that we think about moving forward is to try to understand what the political and political economy / political sources of some of these problems are. I think if you want to go back to why it was that the initial response to the crisis and the German position was as perhaps unproductive or less productive than it might have been, I think to some extent the reality is the Germans were exploiting a very, very substantially strong bargaining position, which is sort of what you'd expect them to do. And then going forward a bit, I think that we have to recognize that if there's going to be a change in the policies, there has to be a change in the underlying understanding of the political economy of the union. And I would come back to what I said before. I think at this point it is still not the case that it's certainly not the case that mass publics have any sense that there is something at stake for the Northern European countries in the outcome of the crisis. But I think to some extent we have to also look at the role of the political leadership in those countries for maintaining what I think is a fiction, that the conditions in the periphery can somehow be inherently separated from the ultimate future of the European Union. So I think I would go back to the underlying political economy of some of these policy choices and look to where there might be ways of intervening there to move towards a more productive and constructive resolution of the crisis.
Thank you very much, Jeff. What I found quite interesting is we didn't talk about what Europeans did in response to the crisis. So we didn't talk about the strengthening of fiscal governance. We didn't talk about banking union. So aren't those solutions to? We didn't talk about the safety nets which have been established. Do these solutions respond to the issues we addressed here? Nonetheless, this was a very inspiring and sobering panel. And we might talk about the macroeconomic imbalance procedure, which is what Europeans tried to do in order to get a handle on regional imbalances next time round at this panel, after your next book has been published.
Don't hold your breath.